Hello everyone, welcome to Just Invest Today. And today we're going to be talking about PE ratios. I'm going to explain it and tell you what you need to know about it. So first off, in the simplest form, the PE ratio is the stock price divided by the earnings of the business. As investors, this is basically just telling us the multiple of earnings the business is sold for in the market. And a lot of analysts and investors use this to see, is the stock undervalued or is it overvalued? And it's a little quick metric to see those two stats. So as an example of showing you what the PE is, say you have a business and it's earning $1 per year and the stock price is selling for $10 in the stock market. The PE ratio would be 10, and investors would use that as a gauge to see how overvalued or if it's fairly valued or if it's undervalued in the market. Because you got to remember that the average PE from going back years and years and years ago has been around 13 to 15. But we have to realize that different industries have different PEs usually. So for example, the bank industry would generally have a lower PE than the tech companies because of the growth potential in the tech field. So sometimes the PE ratio isn't always a good indicator of overvalued companies or undervalued companies. Sometimes companies are just undervalued for a reason. So as investors, we need to figure this out and see if the stock is a good bet. So the PE ratio is all about expectations investors and analysts have about the stock. Usually the higher the PE, the more expectations people have for that stock, right? So investors are willing to pay a higher share price in the market for that stock because of the future growth of earnings. Analysts project for that company in the future. If the business has a PE of 10 and never grows its earnings, it will take 10 years to get your money back from what you paid, but the investors are assuming you won't happen because earnings will grow if the company is strong. But if the business can't meet those earnings expectations, the analyst investors have that business, the share price will be shot down and become very cheap. So the takeaway from the video is that simply the PE ratio is just a reflection of the earnings growth potential. The more earning growth potential, the higher the PE. Analysts and investors use it to see if the company is overvalued or undervalued. But be careful because the PE ratio never tells the whole story about a company. It's just one quick metric. There you have it, guys, a quick breakdown of the PE ratio. If you like this video, can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.